So many of you might have attended our earlier series. In module 1, we gave an overview of foreign trade policy. We covered MEIS and SEIS schemes. In module 2, we covered advance authorization, DFI, and drawback schemes. Today's module is focused on EPCG scheme, deemed exports, and interplay of export refunds under GST laws with the foreign trade policy. Very importantly, we'll be covering two recent amendments. One, the retrospective grant of duty drawback for deemed exports. It's a very positive step which has that too from a retrospective basis. And secondly, recent ruling of WTO, in which they have held most of the export incentives granted by Indian government to be not compatible to WTO regulations. So with this, we start today's webinar. And I'll hand over the session to my colleague Himanshu, who will explain the salient features of EPCG scheme. Over to you, Himanshu.
Thank you, Puneet. So the topic allocated to me is EPCG scheme, which is Export Promotion Capital Goods Scheme. So I will start the same. So the purpose of EPCG scheme is to enable the duty-free import of capital goods, and the reason for the same to produce the quality products and services and to enhance India's manufacturing competitiveness. So the capital, important to know that capital goods includes packaging machinery, refrigeration equipment, power generation sets, etc. The persons eligible for this scheme are manufacturer exporter, either with or without supporting manufacturer. Second is merchant exporter, who are tied to supporting manufacturer. And third is service provider. The duties which are exempt under EPCG scheme are BCD and social welfare surcharge. So these are the upfront exemption of both the duties, where an importer need not to pay any duty at the time of import of capital goods. Another duty which is optional, so that an importer cannot pay at the time of import of capital goods, which is IGST and compensation cess, and the same is available till March 2020, which is likely to be increased beyond that date. The third thing is that eligible capital goods. So an importer can, and a manufacturer or a service provider can import capital goods either pre-production, production, or post-production. The manufacturer can import the same either from outside India or from the domestic market. Second is computer system and software, which are part of the capital goods only. So computer system and software are also can be imported under this scheme. The third is spares, molds, dies, jigs, etc. Fourth is catalyst. The important thing is for the importer is for this actual user condition. So the person who is importing the capital goods or domestically procuring, subject to actual user condition, the meaning for the same is that he must use those capital goods for manufacture of goods. Such capital goods are transferable only after completion of EO, which is export obligation. If a manufacturer or service provider transferred before export obligation, then duty and penalty implications will be there. The important thing is that a person who is importing the capital goods needs to fulfill the export obligation. So that export obligation is 6 times equivalent to the duty saved of like taxes, cesses, etc. So in the previous slide, I explained that BCD, SWS, IGST and compensation cess must be 6 times if they saved all the duties on the imported capital goods. Such export obligation needs to be fulfilled within 6 years from the date of authorization. the exporter needs to be assured that the export obligation must be fulfilled over 3-year above average exports. So for example, in the last 3 years, the average export is 100. So the export obligation will be considered over and above 100. So in case of domestic capital goods procurement, so EO would be reduced from 25%. So in case of import, the EO is 6 times. In case of domestic capital goods procurement, the EO is 4.5 times of the duty saved. It is important here to note that suppose a manufacturer fulfills the EO within the first 3 years, 75% within the first 3 years, then the balance EO will be waived. Then in that case, that person need not need to fulfill any EO in the subsequent years.
So thank you, Himanshu. And if we have to summarize this, 6 is a very important number for EPCG scheme. So whatever duty you are saving, 6 times is the obligation, and you have to complete in 6 years. This is a normal rule. And one important aspect is why the government has kept average level of exports, because the government expects that if presently, even without availing EPCG benefit, you have a particular level of exports, we want you to increase that level of exports, and whatever incremental exports you are making, that only will be counted towards export obligation. 2 special incentives they have granted. If you procure goods domestically, they reduce export obligation by 25%. So effectively 6 times becomes 4.5 times. And there is an early bird price also. If you can fulfill 75% of obligation within first 3 years, then balance 25% is waived off. Yeah, thank you, Manchu. Please continue.
Thank you. The next thing is eligible supplies. So when you are importing the capital goods and manufacturing the final product, then what are the supplies that are eligible for export obligation? So the first is it must be a physical export for the manufacturing of goods. Export of services for the service provider. Supplies to SEZ units and developers. Deemed exports. Deemed exports will be taken care in the subsequent slides. Royalty payment received in freely convertible foreign exchange. And R&D services payment received in foreign exchange.
So here 2 categories which are very relevant, which we often see clients missing them, are supplies to SEZ and deemed exports. So if your company is making supplies for these 2 categories, you can clearly reckon those supplies towards fulfillment of export obligation.
There is another concept in the EPCG which is called post-export EPCG benefit. So in this case, all the duties a manufacturer needs to pay in cash first, and then the export obligation reduces to 85% of the duty saved. And after fulfilling this 85%, a scrip will be issued in the form of like similar to like MEIS and SEIS, which can be used for the payment of BCD. And yeah, so I've explained this point that the scripts can be used for this payment at the time of import of goods.
Yeah. And this is also indeed a very important aspect of EPCG scheme, which government introduced few years back. Many exporters do not opt for EPCG scheme because they do not have a certainty of exports as to whether they'll be able to fulfill export obligation or not. So to them, they can surely go for post-export EPCG. In post-export EPCG, you pay custom duties just like a normal importer. There is no export obligation sword hanging on your head. To the extent you are able to fulfill or to the extent you are able to make the exports on a pro rata basis, you will get the benefit. So say for example, the duty saved was 100 and the export obligation for that should have been 6 times 600. So if you go for post-export EPCG, 85% means 510 is the export obligation. If you're able to undertake 510 export obligation, then you will get a duty credit scrip of 100 rupees at the end of export obligation period. And suppose you are not able to make 510, suppose you are able to make only 50% of that, then you will get benefit of 50 rupees at the end of export obligation period. So many of you may be going through uncertainties of your exports, etc. So you can consider going for the post-export EPCG scheme.
So let us understand the export obligation with the help of an example. So suppose you have imported a capital goods from outside India. So the value of the capital, the value of the machinery, say 1 lakh, BCD you have paid 10,000, SWS is 10% of BCD, which is 1,000, and IGST you have paid 19,980. So before March, you can save all the duties, which comes out to 30,980. So the export obligation for the same is 1,85,880, which a manufacturer needs to fulfill in 6 years. And simultaneously, suppose a manufacturer procured from the domestic market. So the value of goods, say 1 lakh only, IGST paid 18,000. So then they will compute notional duties saved, which includes BCD and SWS in the similar manner. So the total duty saved comes out to 30,980. But I explained in the previous slide, like for the domestic procurement, 4.5 times of the duty saved is the export obligation, which comes out to 1,39,410. Okay, in this example, let us understand what is the meaning of average export obligation. So I explained in the previous slide, like the average export, let's say for the past 3 years is 100. So in the year 1, 2, and 3, 4, so year-wise export of the manufacturer is 80, 110, 125, 150. So in this example, you can see the average export is 100, which the exporter needs to maintain. So in this year 1, the export obligation is not fulfilled. In year 2, 110 is there, but the average export EO is 100. So 10 lakhs attributable to the year 1. In year 3, 10 lakhs attributable to year 1, and the 15 will attributable to year 3. And in this case, year 4, no export obligation will be attributable to any of the years. So the EO fulfillment will be, in year 1 it's 0, in year 2 it's 10, which is over and above the average export obligation. In year 3 it's 25, and in year 4 it's 50. So the total obligation in this example is 85. There is another concept in EPCG authorization, is clubbing of EPCG authorizations. So say for example, you have imported 3 machineries in different years, say year 1, 2, and 3. Then the manufacturer has the option to club all those authorizations. So in the third year, again the EO will be calculated based upon the EO fulfilled in the previous years, and accordingly a new EO will be given to fulfill to the exporter.
So primarily the benefit of EPCG authorizations is that it may happen that an exporter has multiple EPCG authorizations, but due to error or some reason, he's not reckoning exports on a FIFO basis. So suppose more exports he has reckoned towards one authorization and no exports he has reckoned towards other. So this gives a facility of clubbing all the EPCG authorizations and to see them together, so that the export obligation in totality as well as actual exports in totality can be seen to consider the fulfillment.
And the persons eligible for the same, like export products and regional authority, must be the same. And export of the alternative goods and services are also considered for the EO fulfillment. Okay, so let us understand the same with an example. Suppose your EPCG 1 that you have procured a machinery in July 31, 17. Second EPCG machinery you procured an EPCG scheme on January 15, 18. Third EPCG license you have on August 31st, 18.
All these three dates are dates of EPCG authorizations. Yeah.
So the time limit for clubbing all the three EPCG authorization, it has to be done within 18 months from the first EPCG authorization. So in this example, the July 31st, 2017 is the first, and all EPCG 1, EPCG 2 and EPCG 3 will be clubbed because all fall within the 18 months. And say EPCG 4 you have taken on March 25th, 2019, that will not be clubbed in this example.
The government has given 18 months range. So within the range of 18 months, you can cover any of the EPCG authorizations for the clubbing purposes.
So there are certain key procedural aspects which needs to be fulfilled for this EPCG scheme. One is this, that import of capital goods must be done within 18 months from the issuance of authorization. Second is that there is no revalidation of the same. Another thing is that a manufacturer exporter needs to have this nexus certificate, and that he needs to procure from the chartered engineer. That machinery has been installed in the factory, etc. The third thing is installation certificate. That suppose if you have imported the machine from outside India, then within 6 months from the import, you need to submit this installation certificate. And there is an extension for the same for 12 months. It's a one-time extension only. If you have imported spares, then within 3 years from import, you need to submit this installation certificate to the authorities. So manufacturer exporter needs to fulfill export obligation block-wise also. That we will be discussed in the subsequent slides. Another thing is that when an exporter export the goods, then the realization of such goods must be done in this manner. So suppose there is a normal exports, then the exporter must get realization in free convertible foreign currency. Suppose the supply is made to deemed exports, then in this case in Indian currency. If the goods are supplies to SEZ unit, then foreign currency, the money must be received in the foreign currency account. And if the good supplies to SEZ developer or co-developer, then in any currency an exporter must get them. At the last, after fulfilling the EO, the exporter must receive the export obligation discharge certificate from regional authority, and the officer will issue the certificate for this EPCG license. So in the previous slide, I mentioned export obligation must be fulfilled block-wise. So from first year to fourth year, like Puneet explained, an EO needs to be fulfilled within 6 years. So from first year to fourth year, 50% of the EO must be fulfilled, and the same can be extended up to 6 years on payment of 2% of the unfulfilled export obligation. So say for example, you have your export obligation is ₹100, and till fourth year you have fulfilled 40 rupees. So in the context of 50 rupees, 10 rupees is left. So then in that case, 2% of 10 rupees needs to be paid to extend it to up to sixth year. For the fifth and the sixth year, balance 50% needs to be fulfilled, and the same can be extended for an year if you pay 5% of the unfulfilled export obligation or 10% of the enhancement in the export obligation. So if you want another extension for one more year, then the export obligation, then 10% of the unfulfilled export obligation needs to be paid, or there will be an enhancement of 20% in the export obligation. Important thing is that after completing each of the block, RA regional authority must be informed within 3 months after the completion of the block. And if you want extension for this 1 year and 2 year, then the same must be requested to the RA before 90 days of the EO period, which is the export obligation period.
So this is a very important thing to note, that even if you're not able to fulfill the export obligations, say for the first block, 1 to 4 year, you have another 2 years to fulfill that. Even if you're not able to fulfill the overall obligation within 6 years, then subject to 10 or 20% enhancement in export obligation, it can be extended to 8 years as well.
There are certain examples which are very important, which we thought to discuss with you. One is, so suppose an importer imports the capital goods. So in that case, he is not required to pay, suppose he paid BCD, CVD and SAT in the previous regime, prior to GST regime, and exports the goods thereafter. So suppose in the GST regime, suppose the person imports the capital good in the year 2006. So EO needs to be fulfilled till 2022. So suppose by some reason he is not able to fulfill the export obligation in 2020. Then in that case, he needs to pay CVD and SAT along with interest post GST. So the question is that whether the person is eligible to take credit of the same or not. So the answer is he cannot take the credit of the same, but he can go for the refund under this GST for the duties paid in GST regime.
So this is a very transitional issue which is coming up for advanced authorizations EPCG, because earlier what used to happen was that if you're not able to fulfill your export obligation, apart from BCD, you used to pay CVDs and it was available as semi-credit. Now, because the regime has changed, the GST regime no longer allows credit of CVD and SAT. Therefore, you cannot claim ITC of that, but yes, legally you can claim refund of CVD and SAT under section 142 of the CGST Act, which permits refund of any of the semi-taxable taxes. Indeed, this issue is disputable, but in our view, legally you can claim the refund, and in any case, you don't have any other option to get back this money.
Another example is, suppose an importer imports the capital goods and the normal BCD rate on the product is say 10%, and there is a benefit that he may be exporting from some ASEAN countries or under SAFTA agreement, which reduces the BCD rate to 2%. Or say, for example, he is importing capital goods under the project import scheme, which reduces the BCD rate to 5%. Then, and he is exporting the goods outside the India. So the question is whether he needs to fulfill the EO on the 10% or on the effective rate of the BCD. So in that case, the exporter needs to fulfill the export obligation up to the effective rate, which in this case is 2% or 5% of the BCD saved.
So this is also another tax planning opportunity available, that if you're importing capital goods, you can club EPCG with FTA and project import benefits, and the benefit it will give it to you will be that your export obligation will be lesser, because export obligation is calculated as 6 times duty saved. So for computation of duty saved, you need to see the effective duty only.
Another example is, suppose you are importing goods and you have taken the license for this machinery 1, and you have saved the duty of BCD and GST, and suppose you are you have another machinery from where you are manufacturing goods and exporting the same. So the question is whether a person can claim the benefit for this EPCG EO fulfillment or not. So in our view, yes, that that person need not to fulfill that he can export the goods from the same machinery, which in this example is machinery 1. If he manufactures the goods from machinery 2 and exports the same will be considered for fulfillment of export obligation. Another example is, suppose a manufacturer imports the machinery in their plant 1, say in Delhi, and saves the duty. But he has another plant in Chennai and he is exporting the goods from that plant. So whether the exporter can claim the benefit for this EO obligation because the machinery is installed in Delhi and he is exporting the goods from Chennai. So in our view, yes, he can claim the benefit for the export made from Chennai plant, and for the same EO will be considered for the same.
Yeah, thank you, Himanshu. With this, we come to the end of the section EPCG scheme, and thank you, Himanshu, for running through various examples, etc. Now we move on to the next section, which relates to deemed exports under foreign trade policy, and our associate partner Deepak Suneja will be taking this part of the session.
Thank you, Puneet. Deemed exports, as the name suggests, covers cases wherein goods, even though they're not physically moving outside India, but they are granted all the benefits which physical export gets. So the benefit is granted to provide a level playing field to the domestic manufacturers. In this case, the goods do not physically move out of country, and even the payment of the same is received in Indian currency. Now, it is important to understand of what all supplies qualifies as deemed exports. So, supply of goods to advance authorization, supply of goods to EPCG holder, supply of goods to EOU, and some specified notified projects like mega power projects, etc. So, if a domestic manufacturer is supplying goods to an advance authorization holder through invalidation letter or EPCG holder, or even to an EOU, that such supplier, domestic supplier, would be considered as a deemed exporter, and he will be eligible for all the benefits which we will be discussing now. The benefits eligible to deemed exporter are, firstly, just like any other exporter, he too can claim inputs or capital goods under advance authorization holder and EPCG. Further, he can even get the duty drawback of the BCD component. Secondly, he also has an option to claim refund of terminal excise duty. This concept was particularly applicable before GST came into force and now has very limited applicability. So, with the help of an example now, we'll be discussing how exactly can deemed exporter claim a benefit. So, supposedly there is an exporter who is exporting product A outside India. He wishes to buy some goods domestically through a manufacturer in India, and he invalidates an advance authorization in favor of such domestic manufacturer. Now, because such domestic manufacturer is supplying goods to exporter against advance authorization, his supplies becomes deemed export, even though such supplies are going within India only. Now, such deemed exporter, by virtue of his supplying being deemed exports, can obtain advance authorization and import the goods duty-free. So, for deemed exporter, even though his supplies are within India, he will be eligible to claim duty-free imports and need not pay any BCD. So, the intent of this is that the entire chain of export, right from the domestic manufacturer to exporter to goods going outside India, the BCD component does not become a cost at any stage. Similarly, like for duty-free imports, the deemed exporter also has an option to claim drawback. So like in the previous example, once the deemed exporter gets an advance authorization invalidated in his favor, instead of procuring the inputs duty-free, he can procure the inputs on payment of duties, PCD and IGST, and whatever IGST he has paid on his imports, the actual incidence he can claim as refund as deemed export drawback. Now we'll be discussing a recent amendment which has come in this regard. In previous two slides, we discussed that a deemed exporter can either procure the goods duty-free or he can claim refund of the BCD paid by him, which is the actual incidence of BCD. However, recently, the FTP has been amended and the deemed exporter has been given a third option. The third option is that he can claim an all-industry rate, which is the fixed rate as a percentage of duty or percentage of value of the goods as duty drawback. So like once for physical exporters, there's always an option that when they export the goods, they can get a fixed percentage of drawback of the export value of goods. Similar option has now been extended to deemed exporter also. And once he supplies the goods to an advance authorization holder or EPCG holder, he too can get this fixed amount of drawback from the government. The implications. As discussed earlier, only band rate of drawback was available. On this, he could get the actual incidence of BCD, and it was a very complex procedure because he needed to submit the actual bill of entries on which BCD incidence has been imposed. He needed to prove that such inputs have been used in manufacture of export goods. Now, with this all industry rate, he need not do anything, and he can simply, by proving that he has supplied goods to deemed export categories, he can get a flat drawback rate. Most importantly, this benefit is available with effect from December 5, 2017. So even for past period, if for past there have been some deemed export supplies, one can claim this deemed export benefit. Let us now illustrate the example which we discussed in the earlier slides to understand how the benefit would be available to the deemed exporter. So, like in earlier slides, the manufacturer exporter invalidates an advance authorization for deemed exporter. He may or may not have imported procurements, and he has some domestic procurements. Without proving that imported goods have gone into manufacture for the product Z supplied to manufacturer exporter, the deemed exporter would be eligible for drawback on all industry rate basis. Another important point is that even a manufacturer and exporter can claim drawback in this case by getting a certificate from the deemed exporter that he has not claimed such benefit. So Puneet, in this regard, any ideas on how this amendment is crucial and can be implemented by manufacturer exporters or deemed exporters?
Yes, Deepak, indeed, it's a very important amendment. There were certain deemed exporters who found going through advance authorization route as cumbersome. Similarly, claiming brand rate of drawback was not that simple. So to that extent, giving benefit on all industry rate, which is fixed, say 1%, 2%, depending upon products, it's very, very simple for the taxpayers to opt for. And you rightly highlighted that they have made it retrospectively from December 2017. So the taxpayer should go and claim this benefit for the past as well.
Right. So after amendment, now let us discuss what all benefits can a deemed exporter claim. So a deemed exporter who wishes to claim an advance authorization benefit, he can get an EPCG benefit. In addition, he'll be getting an advance authorization benefit. But once he gets an advance authorization, he then cannot claim either BCD drawback on actual basis or on industry basis. Similarly, if an exporter claims brand rate of drawback, he gets EPCG, he gets brand rate of drawback. But then he cannot claim advance authorization or drawback on all industry rate. Alternatively, with this recent amendment, an exporter who wishes to claim EPCG and benefit on all industry rates cannot claim benefit of advance authorization or brand rate of drawback. To summarize, EPCG benefit is available in all cases. In addition to that, an exporter can get either advance authorization, brand rate of drawback, or industry rate of drawback. And an exporter should analyze the cost benefit analysis in each of these options and then choose one of the options which suits him best. Next is the procedural aspect in respect of deemed exports, being the time limit by which you can get this benefit. So this benefit is available from 12 months from the date of supply or receipt of consideration, whichever is later. Importantly, one even has an option to file a claim delayed or belatedly by a late cut fee, which ranges from 2% to 10%. In effect, a deemed exporter can claim benefits up to 3 years from the date of deemed export supply. Another important point here, a question to loom upon is whether such deemed exporter, or for this retrospective amendment, if it decides to claim an all-industry rate, would the late cut fee be applicable in this regard? In our view, it should not be applicable because even only after the retrospective amendment was he eligible to claim the benefit of such all-industry rate. However, even if late cut is applicable, the claim is well within time and there is still another 1 year to claim this benefit. So with this retrospective amendment, deemed exporters should analyze if there are some benefits on which all industry rate is payable and they have not claimed, and they should go for this claim. Lastly, even the manufacturers or the exporters who have procured the goods from deemed exporters. For example, there is a manufacturer who has an EPCG license who invalidated the such EPCG license in favor of the domestic manufacturer for saving the GST component. Such manufacturer exporters also should consider availing this all industry rate in order to reduce their procurement cost. So this would be from deemed export side. Now we move to refunds under GST. So under GST, there are 3 categories of refunds which are available. Firstly is an output stage refund, which is the GST paid on export of goods or services at output stage. Alternatively, if you export the goods or services without payment of GST, you do have an option to claim the benefit or refund at input stage. And lastly, like under FTP, under GST also there is a category of deemed exports. Such deemed exports, there is a refund allowed on supplies of deemed exports in order to reduce accumulation at the exporter's end. We will be discussing each one in detail. But before that, it is important to understand what a zero-rated supplier means. A zero-rated supplier under GST has been defined as export of goods or services and supplies to SEC. The concept of zero-rated is that there is no tax burden on such zero-rated supplier. Now we will be discussing. So zero-rated supplies can be through way of export of taxable goods, export of exempted goods, or export of non-GST goods. Here, it is important that even exempted goods and non-GST goods qualify as zero-rated supplies under GST. Resultantly, as we discussed that there is no tax burden, the exporter of non-GST supply or an exempted goods can get ITC on inputs and input services and claim refund thereon. So it's important that even if a supplier who's not registered under GST, say alcoholic liquor manufacturer, he too has an option to claim ITC for on export of his goods and claim refund of the same. This option was not eligible under excise regime, wherein on export of exempted goods, credit could not be availed, and there was only an option of claiming rebate. Now we will be discussing output stage refund of what type of output stage refund is there under GST. Output stage refund, firstly, it's available on zero-rated supplies. So export of goods or supply to SEZs are zero-rated supplies. A person can claim refund of IGST paid at output stage. Importantly, an exporter can utilize his input stage IGST to pay the same. In fact, an exporter is suggested to go under this option only if there is an accumulation and he cannot utilize ITC for clearance of his domestic supplies. Exclusions. In what all cases can an exporter not claim refund of output stage? Firstly, if an exporter has made some procurements on which he has not paid duty only, let us say he has made procurements under advance authorization, or he has made procurement at concessional rate of 0.1%. The government wants that one should not take dual benefit of not paying GST at input stage and also claiming refund at output stage. So if an exporter has already claimed benefit at input stage, the law prohibits him to claim refund of output stage again. Similarly, if there are some goods which attract export duty, the government bars that such goods being considered a negative list should not be allowed refund. An exception to this exclusion is procurement of capital goods under EPCG. So even if you are procuring capital goods under EPCG, you can very well claim refund at output stage. So if an exporter who has huge accumulation can consider availing both these options together. Firstly, he should use EPCG to procure capital goods duty-free domestically. Secondly, he should also export the goods on payment of IGST and claim refund of such IGST from the government. Now discussing the procedural part of how do we claim export refunds under GST. First is refund of export of goods, which is a completely automatic process. So, as step 1, the exporter of goods would be filing shipping bill. At the time of filing such shipping bill, he would be declaring details of the GST invoice therein. Then the exporter would be filing details of GST in GST return, both GSTR1 as well as GSTR3B. GSTR1 and 3B would then be validated at the GST portal at first step. Once these details match, in simpler words, once the data filed in GSTR1 and 3B matches, the detail would then flow from the GSTN portal to iSgate for validation. The data, once it reaches iSgate already has the details of shipping bill details which are filed. So there would be validation at customs portal of whether data received from GST portal and shipping bill data matches. Once it matches, the refund is done automatically. While this automatic process is very smooth for normal cases, there are some ports which do not have EDI system or wherein the shipping bill are not filed electronically. In such cases, the refunds get stuck. And unfortunately, if there in these 6 steps, if there is mismatch or there's some intervention or something does not matches at any step, the refund gets stuck. And in our practical experience, both the GST authorities and custom authorities do not have any option in that case to grant the refund manually. So we have discussed various errors which are there because of which refund gets stuck. So if you see from the previous slide, there may be details of shipping bill details not matching from the customs portal. EGM may not be filed from the customs department, because of which the data does not get validated at customs side. There may be a GSTN mismatch, that is, at the time of filing of shipping bill, an incorrect GST number was posted. Then there might be an invalid invoice number. If there is any of these errors, the validation would either not be happening at GST portal or customs portal, in which case, because of errors, the refund would not be granted. So one really needs to make sure that at the first time only the errors are not there, so that the refund is smoothly processed. Again, in case there is a mismatch between GSTR1 and 3B, the data would not move from GST portal to the customs portal and refund would not be done. Next comes the process of export of services or supplies to SEZ, which as against supply of goods of exports is a manual process. So in this case, the refund is filed in form GST RFD01 and ARN is generated. The filing of this refund claim is electronic via a recent circular and the recent methodology issued. Once this refund claim is filed, an acknowledgement is issued within 15 days. After acknowledgement, as per the law, provisional refund should be granted within a period of 70 days, which should be 90% of the refund amount. However, in our practical experience, this refund is not being granted. Then, the proper officer who is processing the refund is mandated under law to pass a refund order within 60 days. That order may be positive or negative, but the law mandates him to pass such order within 60 days. On the other hand, if the proper officer notes that there is any deficiency in the application filed, he should issue a deficiency memo, in which case the refund filed would be considered as invalid and a fresh refund needs to be filed in such cases. Notably, the refund application gets time barred. The time bar of 2 years, which is there for filing a refund application, would be applicable even for the subsequent refund application filed after deficiency. Puneet, in this case, I'd like your view on the point that provisional refund of 90% is normally not being getted to exporters. So what's your suggestion? Should an exporter be claiming refund in such interest in such cases, or what should be his way forward in such cases?
Yes, so Deepak, this is a valid point, and since introduction of GST, there have been so much hue and cry on this point. And unfortunately, despite being a statutory provision, these provisional refunds are not granted. And very smartly, while framing the interest provisions, also they have not factored in that this provisional refund is not granted, so an interest consequence will be there. So my suggestion is that the aggrieved exporter should challenge this in High Court through writ petitions only, on the ground that the refund which is due to them is not granted within time.
Right. Thanks, India. So now we'll be discussing briefly the documents which are required for claiming the refunds. So for export of services, one needs to file the BIRC, FIRC copies to prove that export currency has been received. Surprisingly, the refund application also needs to be assisted by Form 2A, GSTR 2A, to prove that the credits are available in such form. It's surprising because the refund being applicable is that of output stage and not of input stage. So once the output stage duty has been paid, and that is evidence, why does the government need to see if the Form 2A has the credits are reflecting in 2A or not? Thirdly, they also require a statement matching the details of export invoice with the BRC copies. And lastly, a self-declaration of non-prosecution is also required. In case of supplies to SEZ, they require a receipt of payment proof from SEZ. They require an endorsement of SEZ officer that the goods have been received from them by them. A self-declaration is required for unjust enrichment. Importantly, this unjust enrichment was recently made applicable by IGST Amendment Act on supplies to SEZ. Earlier, it was not applicable. And lastly, again, a self-declaration is required that the companies have not been prosecuted. So with this, we have discussed the output stage refund, export of goods, or export of services and supply to SEZs. Now we will be coming on input stage refund, which can be applicable.
Yeah. And Deepak, one thing which you should highlight to the participants is that on any day, output stage refund is much better from two perspectives. The output stage refund, you need not prove the correlation between input services, etc., because it is straight away percentage of your sale price. So from that perspective, documentation and grant of refund is easier. Secondly, if you are seriously saddled with the credit accumulation, in case of output stage refund, you will pay GST on the total sale price of your product. So even the value addition or your profit margin, you will be able to encash the credit accumulation to that extent.
Right. So now we'll be coming to input sales refund. So while output sales refund is preferable as Puneet suggested, there may be scenarios wherein one may need to go to input sales refund. Let us say in case of an inverted duty structure or any other case. So we'll be discussing inverted duty refund as well. So inverted duty refunds can be is of three types. Firstly would be a normal refund, wherein the exporter has exported the goods under LUT and he has not claimed any other benefit of concessional procurements. In this case, it's a straitjacket formula. Whatever basis your turnover of domestic of export vis-a-vis total turnover into net ITC, you get the refund. However, there may be cases wherein you are making a procurement partial or fully duty-free, like we discussed for advance authorization. Or there may be cases wherein you are procuring goods at concessional rate. Say a merchant exporter procuring goods procuring goods at 0.1%. In both such cases, because your inputs either fully or partly have not suffered full duty, the government does not wish you to allow double benefit or claiming input sales refund by normal formula. In such cases, the government states that whatever GST has been paid on other input and input services, you claim refund of that. Similarly, for concessional rate, let us say 0.1% if you have paid, you get that. But this you separate it from the normal refund formula. Normal refund you get only if there are no concessional procurements. If there are concessional procurements, you separate this export amount and then claim refund separately. So we'll be discussing through examples of how this refund is calculated. So as we discussed, refund amount is turnover of zero rated supplies divided by adjusted turnover. So this zero rated supplies would be wherein one has not availed any concessional benefit. So like in this example, if the credit amounts of input service and capital goods are 100, 30 and 75. Outward supplies, normal exports are 1000. Duty-free concessional procurement exports are 500 and domestic are 5000. So total turnover is 6500. So for export turnover, only 1000 would be considered. 500 would not be considered. Another important point here is that when you consider ITC, you will consider ITC only of inputs and input service and not of capital goods. So taking this example further, your refund amount would be 130, which is credit on input and input services, multiplied by export amount 1000, divided by total turnover 6500. So you can get a refund of 20 rupees here. Importantly, there has been a writ filed before High Court challenging of how can the legislature restrict the refund amount of capital goods. What's your take here, Puneet? What should exporters who have accumulated refunds do in such cases?
So this restriction of refund on capital goods is not flowing from the Act, and the subordinate legislation like the CGST rules, they can never override the Parent Act. So to that extent, the exporters have rightly challenged it. So if there are companies who have accumulated credits because of capital goods as well, they should also consider having a similar challenge.
A very important point here that if an exporter has significant accumulation, he can also file a writ in this case. Right. Thanks, Puneet. Another important point in relation to refund at input stages, there may be several exporters who may be having procurement of coal on which compensation cess is applicable. And at the time of export, that no duty is payable and compensation cess is not payable, so as to get refund of the same. In such cases, an exporter can even claim refund of compensation cess, being an input duty which is payable. The same is sufficiently clarified by the circular that if an exporter who makes an export under LUT has compensation cess as input, he can claim such compensation cess as refund of input stage. Puneet, do you think an exporter who is exporting goods under LUT also has such an option to claim refund of compensation cess on inputs?
Yes, indeed he has this option, and I feel many of the exporters are missing this option because, especially if you procure items like coal on which compensation cess is there, even the export refund benefit might be significant now.
Right. So the coal exporter should genuinely consider claiming refund of compensation cess. Right. Thank you. So now coming to refund amount for concessional procurements. So in last slides we discussed that if an exporter has some concessional procurements, normal procurements, then there was a formula of how to claim such refund. Now, if an exporter has concessional procurement, interestingly, there's a rule 89(4)A, which has not provided any formula. It only says that whatever refund of ITC on other input and other input services is there, you can claim refund of that. Similarly, for concessional rate as well, there is no formula provided under law of how you need to claim. The law only states that concessional duty paid plus ITC on other inputs and input services you can claim as refund. So in absence of this formula, an exporter who has both exports without concessional rate procurements and exports with concession rates procurement are in effect. Lastly, and more surprisingly, there is no specific form by which this exporter can claim this benefit. So the problem is that once an exporter who files refund under Rule 89(4)A cannot then again file a refund under Rule 89(4)B or 89(4)A. So once he has filed normal refund, he cannot file refund of this concessional rate or duty-free procurements. Another problem is that if he files refund by considering all supplies as normal exports, the refund amount increases and he risks himself through a scrutiny of the department. So this is actually an open question, and our suggestion in such cases, you should then consider all exports as normal exports, file for full refund, and then simultaneously write a letter to the department stating that if our normal computation is X amount, we have claimed X plus Y, you only grant us the refund of the reduced amount. So that you file refund of the full amount and then write a letter for grant of refund of the reduced amount. Right. So with this, we end the refunds applicable at input stage. We discussed refunds through for normal exporters as well as through concessional exporters. Now we'll be discussing a third type of refund, which is refunds under GST, deemed export under GST. So the coverage of deemed export under GST is very similar under FTP. Any supplies to an EOU, to an EPCG holder, or to an advance authorization holder are considered as deemed exports under GST. The benefit of this case, whatever refund of IGST or GST you have paid on your supplies, on deemed export supplies, you can claim refund of the same. Importantly, the benefit is available both to the supplier as well as the recipient. And recipient cannot claim ITC in this case because he is already claiming the refund. So the idea of providing this refund is if supposedly an exporter who exports the goods has already availed advance authorization for some of his inputs. For the balance inputs also, he either had an option to claim a refund as we discussed in the earlier slides under Rule 89(4)A. This option provides him another alternate option that he might invalidate his advance authorization for domestic procurements. And for domestic procurements also, he gets refund of the IGST paid only. So, like for imports for advance authorization, his procurements are completely duty-free. For domestic procurements also, his procurements become duty-free, and there is no accumulation of credit at the exporter's end. So, in this case, the deemed exporter who will be supplying goods to manufacturer exporter, he will be charging GST on his invoice, but then such GST he will be claiming refund from the government. Importantly, now the manufacturer exporter who has procured goods under deemed export, he cannot claim refund of IGST, except for EPCG holder, as we discussed earlier. Now, some general provisions relating to refund. Firstly, interest on delayed refunds. So we now discussed that a refund claim is there. The department needs to issue such refund claim within 60 days. But what happens if the department does not grant such refund within 60 days? In that case, if there is a delay in granting the refund beyond 60 days, the assessee has a right to claim interest from the department. Such interest rate is 6% till the time refund order is issued. Once refund order is issued and still the government does not grant you the refund, the interest rate increases to 9%. The circular, a recent circular by the government has clarified that this 60 days period or the interest would be counted till the time amount is credited to the bank account of the customer. So it's not only that issuance of refund order is sufficient, the department needs to ensure that the amount is credited to the bank account of the exporter until such time the interest meter runs. So here again, Puneet, we need your expert views on. We already know that several exporters have been getting refunds delayed. So what's your suggestion to the export community here?
And Deepak, we have got multiple questions on this also, that though now the people have started getting refunds, etc., but still there's a significant delay in grant of the refunds. So my suggestion will be that wherever the delay is more than 60 days, the exporters should take up the matter with authorities. They should file a formal representation that this is a delay and this much interest they should sanction. And if the authorities do not grant, they should take it up in appeal or through writ, etc. I feel this is a legitimate money which was withheld by the government. So they should surely fight for this, and they will get the interest amount.
Right. So this we have already discussed, the interest of delay in provision refund. So Puneet, why don't you take us through the recent developments here?
Yeah. So thank you, Deepak, for running us through the deemed exports as well as interplay of refund for exports and deemed exports under GST law vis-a-vis foreign trade policy. With this, we are just coming towards the end of the session, and one of the important aspects we want to cover is this recent WTO ruling. So just for everyone's information, that as per the agreement with WTO, which is called SCM agreement, India is no longer a developing country. So the dispute before WTO was that the incentives which India was offering was export subsidies, and various countries like US, etc., was objecting to it because the export incentives granted by Indian government used to reduce the cost of goods for Indian exporters and increase their export competitiveness. Their contention before the WTO was that India should be forced to withdraw these incentives. So importantly, the WTO rendered its ruling against India. One thing I want to highlight is that WTO only permitted export incentives in which are to compensate goods consumed in the manufacture of export goods, and whichever are other incentives like EOU and sector specific schemes, because EOU also grants benefit for capital goods, EPCG scheme which is not only relatable to raw materials, SEZ scheme which is also widespread just like EOU, MEIS scheme which is for offsetting the infrastructural inefficiencies. The WTO found all these things to be non-compliant. Important to highlight that there are two schemes like SCIS, which is for service exporters, and Advanced Authorization DFIA, which were not impacted except to the limited challenge. So, what next? What next is that India has filed an appeal before WTO appellate body. Very important favorable part for India is that if the country has filed an appeal before the appellate body, the decision cannot be implemented. So unless the matter is disposed by WTO appellate body, India can continue to have these incentives, irrespective of they being WTO non-compliant. Interestingly, the US does not want WTO to function. The reason is that the members are not being appointed in the WTO appellate body, and the WTO appellate body is not likely to hear India's case in near future. So to that extent, status quo can continue. India is likely to replace these export incentives with RoSTS TCL schemes, which is rebate of various taxes which will be there. It is likely to come from January 1, 2020, and this is likely to replace EPCG drawback and advance authorization. With this, we come to the end of the session, and the way forward which we suggest to all of you is that please evaluate whether you're availing all the export incentives or not. Unfortunately, the legal or law part of it is not as simple, so it will be good that you seek professional help, that whatever exports, deemed exports you are making, are you claiming all the benefits or not. You need to take a comparative analysis of mutually exclusive options like advance authorization or drawback. Opt for whichever is the most beneficial. Whichever authorizations you have taken, be it EPCG, advance authorization, please regularly track them, whether export obligation is discharged or not, so that you can avoid duty payment and interest. Also ensure that you use advance authorization and EPCG for domestic procurements as well to claim AIR drawback. In case of ITC accumulation, ensure all possible benefits you are claiming. And lastly, if there is an uncertainty to exports, then claim post-export EPCG benefit. With this, we'll come towards the end of the session, and we thank you for joining in very large number, and we have successfully completed this series on export incentives, and thank you once again for joining today's session.